Hi everyone, welcome to our new video. Today we talk about the statement of cash flows. So it's a report that shows how items that affect the balance sheet and income statement affect the firm's cash flows. And here we can immediately see an example. For our allied, in our reference book, we use the same example. For this company, as we see, we have a few major items in this cash flow statement. We have the so-called operating activities, and under the operating activities, there are net income, changes in inventories, accounts receivable, payable, and so on. And then as a second major item, we have the long-term investing activities. We have financing activities, and then there is the summary part that will calculate the net change in cash for this company. And then there is also cash and equivalents at the beginning of the year and cash and equivalents at the end of the year. So we have these items here, and this will summarize us whether the company has added some net cash or there is an outflow. This can be noticed from this statement. And under this statement, as we said, we have several major categories. First of all, we have the operating activities. So let's try to understand what do we have in this part. So this deals with items that occur as part of normal ongoing operations of the company. And then under this operating activities, we have this net income as the first item. The first operating activity is net income, which is the first source of cash, because the company is producing something in this example and they are selling for cash. And if all costs required immediate cash payments, and if the firm were in a static situation, net income would equal cash from operations. However, these conditions don't hold, so net income is not equal to cash from operations, and adjustments shown in the remainder of the statement must be made. So actually this part is actually very important for the cash flow statement, because excluding all the other items, by looking to the net income, we are able to see if the company is producing some net cash flow from its main operation. Okay, the main operation might be, for example, you have a store and you are selling some product. So excluding, by subtracting all the costs that are related to your operation, you calculate this net income. So it is an important item because it shows your performance over time in your main activity. But of course, we have these other adjustment items that should be considered as well, because as a company, we are utilizing maybe some fixed equipment, or we utilize some buildings, and these require also some depreciation and amortization, because they have a specific or expected lifetime, right? If you have fixed equipment you are using in your production process, the depreciation of this item should also be considered, because after, let's say, 10 years or 15 years time, you will need to replace that with a new one. So these should also be considered under the operating activities. So the first adjustment relates to depreciation and amortization. And for our example, this company, Allied, accountants subtracted depreciation and assumed that this company has no amortization expense, which is a non-cash charge. As I said, we are considering this, but actually we are not immediately paying out a cash for this depreciation or amortization. Therefore, depreciation must be added back to net income when cash flow is determined. So here we can see the net income is given as 117.5, this is millions of dollars. And then we have depreciation amortization. This is actually already subtracted when we calculate this net income. So actually we are adding this back because this cash is not spent from our pocket, right? Still this 100 million is actually in our cash, but we are subtracting this when we calculate the net income because that's also part of our cost. And then we have some other items such as increase in inventories. To make or buy inventory items, the firm must use cash. It may receive some of this cash as loans from its suppliers and workers, but ultimately any increase in inventories requires cash. So Allied, this our company in the example, increased its inventories by 200 million, let's say in 2014, in the year 2014. That amount is shown because it is negative, a use of cash, right? That is, we have spent some money out of our pocket to purchase these or produce these inventories. If Allied had reduced its inventories, it would have generated actually a positive cash. So if we look at here, the increase in inventories is considered as a cash outflow. So this 200 million went out of our pocket, as cash. So this is subtracted. And then we have an increase in accounts receivable. Basically, if Allied chooses to sell on credit when it makes a sale, it will not immediately get the cash that it would have received, and basically that's going to be again a negative item here, because anything that reflects here as an increase in accounts receivable means the other party has an obligation to give us cash at a later time. So this is going to be subtracted as a cash outflow in this statement. And then we have the increase in accounts payable. Accounts payable represent a loan from suppliers. Allied bought goods on credit in this example, and its payables increased by, let's say, $30 million this year. This is treated as a $30 million increase in cash. Basically, if Allied had reduced its payables, that would have required or used cash. So again, going back here, we have increase in accounts payable. So basically that's reflected as a positive effect on our cash flow. And then as you see, there is the increase in accrued wages and taxes here. The same logic applies with this item. Basically, if we have an increase in accruals or wages, which means that it borrowed an additional 10 million from its workers and tax authorities. So any increase in our payable, right, to other parties is reflected as an increase in the cash. So we consider this as also a cash inflow, as you see here, that's 10 million. And increase in accounts payable again is a potential inflow of cash. Increase in accounts receivable, this is opposite, because we are we owe, accounts receivable is what we will receive. So an increase in this one is considered as a cash outflow. Okay, net cash provided by operating activities. Then these items are all summarized together, all of these previous items. Then we sum them and obtain the net cash flow from operations. And in this example, our company had positive flows from net income, depreciation, and increases in payables and accruals, but it used cash to increase inventories and carry receivables. So basically, as a result, going back, we have net cash provided by operating activities as the sum of these positive and negative. So these are negative with parentheses. We represent them with parentheses. And overall, we have 2.5 million net cash provided by these operating activities. Okay, and then we have the second major category given as long-term investing activities. As we said, the company actually, other than its own main operating activities, it might have these long-term investing activities. These involve long-term assets that are purchased, for example, by the company. And in this company, Allied, had only one long-term investment activity. That's the acquisition of some fixed assets. Again, going back here, we see only one item here, additions to property, plant, and equipment. That is the total of this long-term investing activity is 230 million. So again, the company spent some money to add property, plant, or equipment. That's a cash outflow. So it's a negative number in our overall statement. And then, of course, we should sum up all these items here. We only have one item, so the net cash used in this category, long-term investing activities, we will just sum only one item. So that's the same number, 230 million. And then the next in our list is the financing activities. And if we go to financing activities, we have again a few subcategories under this. Now notice that financing activities include notes payable. This was not included in the operating activities. Notes payable, these are interest-bearing loans, for example, from the bank, or we might have the bond, okay, that is issued by the company. So if the company issued some bond, this will be reflected in the notes payable. So Allied borrowed an additional, for example, 50 million from its bank this year. So this is a cash inflow. So when we borrow some money or when we issue a bond, that will be reflected as an increase in the notes payable. And in this example, we have an increase of here 50 million additional borrowing. So that's a cash inflow. Increase in bonds, again, cash inflow. What can be the outflow here? The payment of dividends to stockholders, because we pay to our shareholders. This is a cash outflow from the company. And then once you enumerate all these financing activities related inflow, and here we have an outflow, right? These are plus, and then we have a negative item here, and then we sum these together, and that will give us the net inflow or outflow if this number is a positive number, which is the case here. So we have an inflow of $162.5 million from the financing activities. And then there will be we have Yes, we have the summary basically after this item. And then that's going to summarize the change in cash and cash equivalent over the year. And the net sum of the operating activities, investing activities, and financing activities all together is summarized here. And in our example, this resulted in a 70 million net decrease in cash. And again, let's go back and see here. So when we look to the summary now, notice that operating activities, we have this 2.5 million. This is a negative number, so it's an outflow. And then we have net cash from long-term investing. Again, we have negative value here, negative value. And then financing activities. Basically, we borrowed money as a company. We have these notes payable or bonds, and then we paid some dividends. So this gives us 162. And then when we sum these items together, so 2.5 minus 230 plus this number here, that gives us minus 70 million as the net decrease in cash for this company. So cash and equivalents at the beginning of the year, we had 80 million cash and equivalents. This is from our basically balance sheet. Okay, this number is also from our balance sheet. And then at the end of the year, we subtract this 70 million cash outflow from the beginning value of 80 million. So that gives us 10 million remaining. Okay, so for this company, there's a significant as of 2014, there's a significant cash outflow, and actually the cash and equivalents is now much lower. Okay, so this is just as an example, a hypothetical example, but you will consider the same steps for any company, and after numerating all these items, we sum them together, the plus or minuses together, and then we will calculate the new cash and equivalents at the end of the year. So this is for the cash flow statements. We will stop here and then continue from here in the next video. Thank you.